Hello everyone. Welcome to Demand Supply Trading Practical session number 38 for the year 2024. Myself Srijit Kakkar, and today is Sunday 6th of October 2024. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on WhatsApp where we update you regarding the upcoming sessions, or if we have any offers coming up, we also update you regarding that. Even if we have, let's say, any videos or updates with our products and services, all those updates are shared on this channel. So, in case you have still not joined this channel and you wish to do it, the QR code is available on your screen. You can scan this QR code to join the channel. Otherwise, the link is also available in the description. You can click on the link and you can directly join this WhatsApp channel. So, talking about today's session, it's a practical application of demand supply methodology. So, our demand supply course, which used to be an absolutely free, which used to be a paid course, is now available absolutely free of cost. So, everyone can learn the complete methodology. Link to the course content is available in the description. The course is available in two languages, English as well as in Hindi. So while you go through the course content, you will be learning the demand supply methodology theoretically, that what demand supply is, how to identify the zones, how to qualify the zones, but we also require practical hand holding so that we can understand how to plan trades in a very mechanical and rule based way. And that is what we do in these sessions. So every weekend I do a practical session where I pick some example, and to that example we apply the complete methodology so that you can learn and understand how to plan trades very mechanically, very rule based. Now the beauty of these sessions is that I'm not picking something which is already played out, because uh, a trade which has already played out, it's very easy to apply any indicator, any oscillator, and come up with a number of reasons why we would have been a buyer, or why we would have been a seller for that particular trade, because the move has already happened. Yes, we can find a number of reasons to participate in that move now. But the beauty is when you're doing the analysis in advance, and that is what we do in these sessions. We do our analysis in advance, that what are the areas where we would like to be buyers and sellers. So I'm doing the analysis for you even before the move has happened. And just because I'm doing the analysis in advance does not mean that I share these examples with you and then we forget about it. Whatever examples I'm sharing with you, we also track them. So eventually, when they get triggered, when the prices they revisit those areas of demand and supply, we review those examples and see how they worked out for us. And doing this definitely helps you build more confidence in the methodology, because the more number of examples you will see, you'll start believing the methodology, you'll start having that trust in that methodology, and that is how we start focusing on it. So yes, that's the beauty of these sessions. We do the analysis in advance, plus we also review them. So talking about the review, we do have one trade example which was getting carried forward for us. So we'll start with the review of it. And once we are done with the review, then we'll start with our today's example. So just give me a second. Let me bring up the example that is pending for review. Just bear with me for a few seconds. All right, so the one which is pending for review is from session number 35, which was on the 15th of September. So we did the session on the 15th of September. It was a type 2, type 3 trade for us. As a type 2, type 3 trader, we talked about that, yes, as a type 2 trader, we could have got a deeper entry into it. And as a type 3 trader, this is where the prices they left the zone, and you could have also got your type 3 trade on this. Unfortunately, prices they did not hit our 1:1 mark. If it would have made to 1:1, we would have also got the opportunity to make it as a break-even trade. But we talked about, let's assume that we are still participating at the original proximal and the distal. Even if you did it as a type 2 trade, we are not saying that our risk has reduced, because in that case, you would have already got the opportunity to make it as a break-even trade. I'm still going with the original entries and the original stop losses. So based on that, in the last week, you saw the markets, they definitely went a little bearish, and the prices, they started coming down, and we would have been out of the trade on Friday, which would have been a stopped out trade for us. So we will be closing this trade now as a stopped out trade, and that is what would have happened in this one. Yes, it is unfortunate that we did not get the opportunity to make it as a break-even trade. If the prices would have gone a tad higher, maybe we could have also converted into a break-even trade. So instead of having a losing trade, could have been a break even trade, but this ends up as a stopped out trade for us. And that basically closes the only example which was getting carried forward for us. And now that we are done with the trade example, we can start with our analysis for today. So just give me a second. And the beauty is, it's not that I only review the trades where we were profitable. So I try to be as transparent as possible, because you also need to understand that no matter what methodology you're using, every trade is not going to be a profitable trade. And by going through all these examples, eventually you understand that yes, it is part of the parcel. You will have winners, you will have losers, but as long as you have good reward to risk ratios, you can net be profitable traders. So do not assume that if I'm reviewing some trades for you, they will always be only the positive trades. I try, like I said, I try to be as transparent as possible. I cover everything which we have analyzed in the past, irrespective whether it was a profitable trade or whether it was a stopped out trade, because I like to show you the reality, right? Because you need to understand, trading is not always about making money, it is also about managing your risk. So if a trade is going against you, you will have to take that loss and you will have to exit that position. All right, so that takes care of the only trade which was getting carried forward for us. But yes, I would also like to add that in that example, if you go back into the analysis, we also talked about that we had a weekly zone, and I would have preferred to use the weekly zone for that particular setup. The weekly zone has not yet been violated. So we are still in the weekly zone. Let's see how it eventually plays out. But yes, somebody who was using the daily zone would have been in a stopped out trade, and that is how we'll close it. All right, now coming back to today's example, so let's get started. So whenever we talk about trading, always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video, and the title of that video is How to Start Trading. In case you have not yet watched that video, do ensure you watch it. The link is available in the description. The video will help you understand why it is very, very important for us to be rule-based and mechanical, plus what process we should be starting with. That also uh, makes it easy for you, because if you know this is how I need to start, the starting definitely becomes much easier, and also helps us avoid big losses if we are going with the process that has been explained in that video. And eventually what you'll also realize is that once you go through that process, probably twice or maybe thrice, you start becoming more of a rule-based trader versus a trader who is planning trades and executing trades and managing trades based on emotions. All right, so coming back to, like I said, we need to be a mechanical and rule-based trader. So what we need to do is we need to create something which is called as a trade plan for us. And what is a trade plan? Your trade plan is basically a collection of all the steps, all the rules which you will be following, from identifying your setups to qualifying your setups to taking the trades to managing the trades, to your position sizing, which is part of your risk management, to your exits, be that your profit exit, be that your stop loss, be that your break even, be that trailing stop loss. So everything that we do, from planning the trade to executing the trade to managing the trade and then exiting the trade, has to be part of that trade plan. Now, when you are starting trading as a fresher, or let's say even if you have a lot of experience but you're learning a new methodology, it's not very easy to create a trade plan from day one. And the reason for that is lack of experience. Unless and until you have good enough experience with the methodology, you cannot convert it into a rule based process. And to overcome this challenge, I have created two documents for you. The first one is your trade plan steps, which basically guides us what we need to do as a demand and supply trader step by step. You can also call it as the flowchart or the walkthrough. And all these steps, they have their own elaborate rules which are available in the rulebook. Now, mind it, this rulebook that I've shared with you is a conservative approach, because whenever we are learning something new, definitely makes sense to start conservative. With time, with experience, if you want to make aggressive, yes, you can make it aggressive. You want to make it super aggressive, you can do that. You want to make it super conservative, you can also do that, because every trader has a different personality style, and based on those personality styles, yes, eventually you'll have to make some tweaks. And while I go through these sessions, I also keep sharing different small little nuggets with you. Okay, this is how you can make it much more let's say aggressive, this is how you can make it much more conservative. So all those things I do share with you, because every trader is not the same. Every trader has a different personality style, so you can make those modifications as you gain more and more experience to have a trade plan which is more aligned with your personality style. So what is our step number one whenever we start planning our trades? Step one is I need to define my trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies what is my expected duration of the trade, which is from the time I enter the trade to the time I exit the trade. What am I anticipating? How long will I be in that trade? And why are we doing that? So, again, it's from the time you enter the trade to the time you exit the trade. And like I said, the exit can be in profit, which is your target. The exit can be break even. The exit can be your trailing stop loss. The exit can also be a stop loss, any kind of exit. So now the question is, why are we starting with trade purpose as our step number one? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have n number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these n number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frames. We start by first defining our trade purpose, because logically, the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. And this is why that's our step number one. We first define our trade purpose so that we can choose time frames which are in sync with my trade purpose. So what I've done is I have divided these trades into four different purposes, and we call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, by definition, I said daily income is a trade which can last for a day or few days. But remember, when you're trading markets which are not 24-hour markets, so example, if I talk about the Indian NSE market, it's not a 24-hour market. So I'm pretty sure all of you would have experienced whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market which is not a 24 hours market, we do have that gap risk involved, which cannot be avoided. And that is the reason my recommendation to all of you is that initially our hourly dailies will be strictly intraday trades. We don't want to take that unnecessary overnight gap risk. So this is part of our risk management. Now, when it comes to weekly and monthly income trades, anyhow, we are not expecting we'll be getting the exit the same day, but at times, yes, it can happen, but generally we're not anticipating to have the exit the same day. So this is where we have no choice, but we'll have to keep these positions as overnight positions. But that does not mean that we cannot have a gap against us for weekly monthlies. It can still happen, but the probability reduces because we start leaning against some bigger time frames. Plus the zones are also a little wider, due to which the prices might not gap beyond the zone. It might go a little deeper into the zone, but might not go beyond the zone, right? So that is where you have a little bit of safety net, but yes, it can still happen. So yes, initially hourly dailies strictly intradays, intraday, weekly, monthlies, overnight. But with time, with experience, if you want to include the daily incomes into overnight trades, that can also be done, because by definition, it is definitely a trade which can last for a day or few days. Initially, we would like to avoid it. So my step number one is I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have decided my trade purpose, what is going to happen from the rule book, I'll get to know what time frames I should be using. So if I go to page number 28, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, the intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits, and the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So now we know what are the 4 different time frames we use. Sorry, what are the 4 different uh, time frames we use, and what is the purpose of these time frames? Now, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example, I opted I want to plan monthly income trades. So now I know as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate used for trend analysis. Lower time frame will be daily. That is where we get our SETS from. SETS stands for stop loss entry target and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart. So as soon as I'm done with my step number one, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So now I know my time frames are monthly, weekly, daily, and 60. So my challenge number one, what time frames I need to use, what analysis I need to do on each and every time frame, taken care. Now the next challenge is, yes, I do know my time frames, but let's again take the example of the NSE market. So if I take the example of NSE market, on NSE market I have about 2000 plus companies listed. So it's not humanly possible that I sit and analyze 2000 companies every day. So what we need to do next is we need to have a process in place which can help me get a smaller list out of these 2000 companies. And the way we do that is by following our step number two, which is selecting some scripts. And how do we do that? For this, we use certain computer programs which are called as scanners or screeners. And what these computer programs, they basically do is whatever conditions we input into them, the computer program identifies that out of these n number of symbols, which symbols are matching with those conditions. Whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, very, very important thing which you always have to remember, irrespective what scanner or screener you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell these symbols. So remember, scanner screeners, they never tell you what you need to buy or sell. Scanner screeners only assist you in getting a smaller list out of a big enough list. Once you have that small list, you will have to analyze it manually and check which one matches with your trade plan. The ones matching with your trade plan are your opportunities. The ones which do not match with your trade plan, you simply skip them. Now, a few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created some scanners for you. And those scanners are based on some moving averages. They can help you shortlisting symbols using that. Second example, on my YouTube channel, search for scanner and you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that for shortlisting symbols. That example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll also be able to find a video on top-down analysis, which can help you in shortlisting symbols. So these are 3-4 different examples which can help you shortlist symbols based on different logics. And let's also look at some of these examples. So like I was talking about, that once you go to our website, on the free tab, you have the option which says stock screener. Because I opted I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting about 14 symbols for me, and the short scan is not shortlisting anything for me. So like I already said, just because you're getting these 14 symbols from your long scan does not mean I'll blindly buy these 14. Similarly, if the short scan was generating some results for me, does not mean I'll blindly sell those X number of symbols. So the job of the scanner is never to tell you what you need to buy or sell, but the job of the scanner was, since I can't analyze 2000 plus companies every day, it helped me get a list of 14 symbols. Now I will analyze these 14 manually one by one. Out of these 14, if anything matches with my trade plan, I have an opportunity available. If nothing matches with my trade plan, I don't have any opportunity available. Now, many times what can happen is your list can be a very small list. Like you can see, we only have 14 symbols. Or maybe the scanner is not generating any results because nothing is matching with these conditions. Now, the smaller the list, the lower is the probability that you'll be able to find something which might be in sync with your trade plan. So if you want that when I use these scanners, the list should not be a very small list. I maybe want a little bigger list. Then what you can do is you can see that in this scanner, I have given 5 different conditions. Out of these 5 conditions, you'll disable the third one, you'll run the scan again. And I'll do exactly the same thing here, disable the third one, run the scan again. So initially you saw that it was giving me a list of 14 symbols, but now I have a list of 156. And if I go to the short scan, I have a list of 5. So 156 plus 5, I have 161 symbols to look into. Now, if you feel that this is a very big list, you don't want such a big list, you can use a few filters. Example can be, I can say I don't want from the cash segment, I only want the ones which also get traded in futures. So now you can see instead of 154, I only have 54 symbols to look into. So you can make this list bigger, you can make this list smaller, based on different scanners, based on different conditions, based on different filters. And this is not the only scanner available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners available to you. Some of them are based on fundamental analysis. Then you have your top left. Some of them are based on candlestick patterns. If I further go down, you can see you have based on range breakouts, you have your bullish scan, you have your bearish scan, you have your intraday bearish, you have your intraday bullish, you have crossovers. So you have n number of scanner screeners available to you, and this is example of one website. If you do a Google search, you'll be able to find n number of websites, n number of scanner screeners, which can help you get a smaller list. Now in this example you saw, we got a list of about 161 symbols. Now once you start analyzing them, few challenges which you will realize, and what are the ways we can also overcome those challenges, we'll also talk about. So challenge number one, what you'll realize is that once you start analyzing these symbols, you will find majority of these symbols, they don't have any quality demand zones or supply zones on the lower time frame. And unless and until you have a quality zone on the lower time frame, you can't plan a trade, right? Because we need a quality zone to start planning a trade. And the reason behind this is because all these 150,000 plus scanners that I showed you, they are either based on conventional technical analysis or fundamental analysis, which is why just because something is getting shortlisted does not guarantee that you'll have a quality area available to you. So that's the very first challenge, that just because something is getting shortlisted does not guarantee that we have a zone on that particular symbol, which means I will be wasting a lot of time analyzing such symbols where nothing tradable is available to me. Second challenge is, if few of these symbols, they do have some quality demand areas and supply areas, those quality demand supply areas might be far away from the current market price, due to which I'll have a longer waiting period, because unless and until prices they come back to my demand zone, supply zones, I can't enter into a trade, because that is what demand supply methodology is all about. We need those retracement prices have to come back into our areas of demand and supply before we can participate. So these are some of the challenges we face when we are using scanner screeners which are not based on demand supply methodology. And the solution to them is that we also have to custom build tools. One is called as the alert service, the other one is called as the screener. Again, the link to the walkthrough videos are available in the description, so those walkthrough videos will help you understand these tools in depth. But I'll definitely just touch the surface so that you can understand how these tools they basically work. But before we get into that, again, very important, these are not call giving or tip giving services. These are scanner screeners. The only difference is that these scanner screeners are purely based on demand supply zones. So the way alerts they basically work is that during the live market, as soon as we have a formation of a demand area or a supply area, you get notified. Now we do have demo channels for NAC alerts, for MCX alerts, and few forex symbols. So I'm showing you examples from the NSE demo channel. You can see this is for the 4th of October, which was Friday. And you can see as and when the demand supply zones are getting formed, you keep getting these updates at what time the zone has formed, on what time frame the zone has formed, what is the proximal value, what is the distal value, what is the name of the symbol. So you can see this is your daily alerts, and then now you have your alerts from the 60 minutes time frame, from the 5 minutes time frame. This was at 11:20, then you can see at 11:25. So as and when these demand and supply areas are getting formed, you immediately get the notification on which symbol, on which time frame the zone has formed. But remember, just because you have a formation of a zone does not mean you can blindly trade it. Like I already said, this is not a call giving or a tip giving service. This is a scanner which is telling you, okay, on this symbol we have a formation of a zone on this particular time frame. Once you have that information, you'll have to go to that symbol, you'll have to analyze that particular demand area or supply area and check, does it match with your trade plan. And if it matches with your trade plan, it can be an opportunity for you. If it doesn't match with your trade plan, you simply skip it. So again, alerts are based on the zones which are getting formed during the live market, and that is what they do. They help you quickly understand where these zones are getting formed. Now the second tool we have is the screener. Now the way the screener basically works is, like here you can see I have given my list of about 40 symbols, and then I've given my condition that my proximity percentage is 1%, which means When my current candle is within 1% to a demand area or a supply area, shortlist it for me. So now you can see I've given a list of 40 symbols, and out of 40 symbols, it is telling me that only one symbol is close to the demand area and only two symbols are close to supply areas, which implies that if I was manually going through these symbols, I had to analyze all the 40 symbols. But now I know I can only analyze these three because these three are closer to demand and supply zones where I might get an opportunity based on my proximity setting. So, example, if I go to Titan, you will see on Titan will be closer to a demand area. So here you can see we do have a demand zone and my current candle is pretty close to it, and that is why it got shortlisted for me. Similarly, if I go to SBIN, you will see that on SBIN I'll be closer to supply area. That is why it is getting shortlisted for me. So you can see you have your supply and the current candle is pretty close to it. And if I want to now change it to some other time frame, because currently I was on the daily, it is giving me the results based on daily. If I change my time frame to weekly, now you will see the scanner will scan the 40 symbols and give me the results based on the weekly time frame. So you can see that is how simple it is, and it only throws the results where you are within that proximity range to a demand area or a supply area. And currently I've applied it to only one chart and have a list of 40 symbols. I can apply to multiple charts and I can have as big as a list I wish to. So this is how the scanner can help you a large enough list of symbols and only give you the results where you are in that proximity range. So yes, you have two tools available which are purely based on demand and supply methodology. But again, step number two was to get a smaller list for you. How you get that small list, completely your choice. It's not that these are mandatory tools, but obviously the more you are in sync with demand supply methodology, the smaller might be the number of symbols you have to analyze, and the higher might be the possibility that you might find something which is in sync with your trade plan. So at the end of the day, it's your choice how you want to get that list. Process can be as simple as I just want to analyze my Nifty 50 stocks, or maybe I have my own favorite list of symbols which I might want to analyze. So choice is yours how you want to get that small list. But once you have that list, we are all ready with the information we require to move on to our step number three, because from our step number one I got to know my time frames, and from my step number two, now I know what symbols I'll be analyzing. So I have my symbols, I have my time frames. I can move on to my step number three where I need to go to the lower time frame. So the question is, what is my lower time frame? We have the answer from step one, that as a monthly income trader, daily is my lower time frame. So we'll go to the daily chart and we need to identify a zone. And by zone, we mean any of these four structures. It can be a drop based rally, rally based rally, rally based drop, or a drop based drop. So let's assume the very first symbol which got shortlisted for me was ABC. So let's assume this was ABC. And now I'm on the lower time frame. So here you can see I have already applied the demand supply zone indicator. So again, we have an indicator which is called as demand supply zone indicator, which automatically identifies the zones for us. So I don't even have to identify the zone now. The process is getting automated. And if you want to try it out, we do have a demo version available. So on TradingView indicator list, you can search for demo demand supply zone indicator. You'll be able to find it. You can try the demo version. But mind it, this indicator is a very advanced indicator. It is not based on boring, exciting technique. It is based uh, on price action. So whenever we talk about demand supply methodology, I always say demand supply is a price action based methodology. Now, what do we mean by price action? Price action means the action done by the price. And what action can price do? Only two things. It can either move up or move down. It cannot do anything else. But when price is moving in a narrow range, we call it as the period of pause, or we can also call it as the basing. Now, initially, when we start learning demand supply methodology, our eyes are not trained to identify these structures. So what we do is we start with a concept which is called as boring, exciting technique. Because you will see that majority of the zones can be identified using boring, exciting technique. And what we have also done is the boring candle indicator and the explosive move indicator, we have made them as 100% free indicators. You can use them for free forever, and they can help you start training your eyes to understand how these zones might look like on the chart. But once your eyes are trained, then eventually from boring, exciting, you'll start shifting towards price action. And that is what the demand and supply zone indicator also do for us. So just as an example, if I zoom out, you can see the price action is telling us that we came down, we paused for a while, we started moving up, and that is the reason the indicator is marking it as a drop based rally for us. And similarly here you can see we came down, we paused for a while, again started moving down, which is basically a drop based drop structure, which the indicator is marking for us. Here again you can see we moved up, we paused, we started moving down. That's a rally based drop, which the indicator is again marking for us. So you can see the indicator does the process of identifying the zones for us automatically, which again makes our life easier, faster, and again mechanical as well, because if the indicator is identifying something, it is based on certain algorithms, and those algorithms will always bring in that consistency that we are being very mechanical and rule based. So yes, my job was to identify a zone, and here you can see we already have a drop based rally, so let's mark that. So my step number 3 is taken care of. It was identify zone. Do we have a zone available? Answer is yes, we do have a zone available. Now, once we have identified a zone, it does not mean that I can blindly buy at a demand area or blindly sell at a supply area. And that's the biggest mistake demand supply traders they do initially. They find any demand area, blindly start buying. They find any supply area, blindly start selling, which is incorrect. Once the zone has been identified, the next step is to qualify it. And for qualification, we have a two-step process. In step 1, we'll qualify it based on certain conditions. And if it gets qualified based on these conditions, then we move on to the next step, which is our boosters. And we understand its quality and the probability factor. So the very first thing we look into is that can this zone be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area, and that is why LOTL is the very first condition we look into. And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame, so when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So the first thing we understand from here is that to be a case of level on top of level, my lower time frame zone has to be completely inside the intermediate zone, which is called as a coinciding level. So if we have a coinciding level, it might be a case of level on top of level, but if we don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? And in this case, our intermediate time frame will be weekly. And here you can see on the weekly, we do have a drop based rally structure available to us, which the indicator is also marking for us. So let's mark this drop based rally, and I'll use a different color. So the one in pink is my intermediate time frame zone. The one in green is my lower time frame zone. So is my lower time frame zone completely inside my intermediate time frame zone? The answer is yes, which makes it as a coinciding level. So we know for sure we have a coinciding level. But to be a case of level on top of level, we need to have multiple zones. And in case of level on top of level, it is not mandatory that the other zones might be quality zones. So what I'll do is I'll change the indicator settings that I want all zones. I just don't want quality zones. And even after changing these settings, you can see that we only have one zone inside of it, which means we only have a coinciding level. We don't have a case of level on top of level. So it's just a coinciding level, but not a case of level on top of level. So going back, yes, we don't have a case of level on top of level. We don't even have a case of gap. Now, talking about pivot non-authenticity, it is definitely a drop-based rally structure. And drop-based rally, we always consider as pivot or a non-authentic zone. So how do we qualify it? So if I go to the pivot rules, you will see the pivot rule says that as an aggressive trader, before applying the boosters, make sure that the move from the zone was able to violate at least one opposing zone on the intermediate time frame. So what we want here is that this move from the zone should have violated an opposing zone. So if this is demand, opposing zone would be supply. So this move should have violated a supply, but that supply needs to be of the intermediate time frame, because if a smaller time frame zone has violated a bigger time frame zone, that basically implies it might have strength, right? So that is what we are looking for. So if I go to the weekly time frame and I do a candle replay where our zone was formed, you can see that when the zone was formed, we did have some supply areas here, and when the prices they started moving up, these supply areas were violated. So the condition which we were looking for, that we should have a violation of an opposing zone on the intermediate time frame, we do have that. So if I am a person who's following the aggressive rule, based on the aggressive rule, the zone is qualified for me. Now, if I'm a person who's following the conservative rule, now why do we call it as a conservative rule? Because here I'm not looking at one condition, I'm looking at two conditions. So the condition number one is I need an impulsive move on the intermediate time frame, and the condition number two is that we also need an authentic zone on the refining time frame. So by authentic, I mean in case of demand, a rally based rally. So here you can see that on my intermediate time frame, I'm already on the weekly time frame. The move from the zone was able to breach the previous high and create a higher high, which is basically called as an impulsive move. So we definitely have an impulsive move, but do we have an authentic zone on the refining time frame? Let's also verify that. The refining time frame is hourly, and on the Ali, you can see that we do have quite a few drop based rallies, but we don't have a rally based rally. So we don't have an authentic zone on the refining time frame. So if you are someone who is following the aggressive approach, yes, it is a qualified zone for us. But if you are someone who is a little conservative and you were applying the conservative rules, then in that case, it is not a qualified zone for you. Now, a few modifications here can be, like I said, different traders, different personality styles. So, because we understand a drop based rally can be a non authentic zone, what we are trying to do is we are trying to add some positive factors. So, as an aggressive rule, we were looking at a violation of opposing supply area, right? As a conservative trader, we were looking at an impulsive move, and we also wanted on the refining time frame an authentic zone. Right now, if you also look at this example, this was a case of a coinciding level. So what I'm trying to show you here is, can you see we have one condition which is matching for us, we have another condition which is helping us, we have another condition which is helping us. So eventually, based on your experience, if you want to make some modifications, because we need to add positive factors, those positive factors can come in a number of ways. So I've just given you two different examples, which is what is available in the rule book, right? A third example can be, okay, I'll be looking at all these four conditions. If I have any two conditions, it is qualified for me. Or I need at least three conditions, then it is qualified for me. So that is how you can make your process or your trade plan more conservative. You can make it more aggressive. So I'm just showing you examples how those modifications can be done eventually based on your experience. But let's assume I'm a aggressive trader, and based on my aggressive rule, it is definitely a qualified zone for us. So I can move on to the next step, which is unstable equilibrium. That is not applicable. So after looking at all the applicable rules, is the zone qualified? The answer is yes. The only time it will get disqualified is if I was applying my conservative rule. So if you're a conservative trader applying the conservative rule, this is not a setup for you. But if you're an aggressive trader following the aggressive rule, yes, this is qualified for me as of now. Now, the next thing is, just because it is qualified, I still can't trade it. Now, I need to understand its quality and the probability factor, for which we'll apply the boosters. First one is freshness. The zone is definitely fresh, gets a score of 3. Talking about strength, because I'm on the daily time frame, I generally use, even as a single leg out, I use good. For the strength, if I shift it to explosive, then I'm pretty sure the indicator will not identify it. So we know that we have a good move, but we don't have an explosive move. So for a good move, we'll give it a score of 1. Time at the zone, we only have 3 candles in the basing, which again gets a score of 2. Reward to risk ratio, we are taking as an assumption. Now, talking about the location, you can see that we are planning this trade at the best location, which is very low of the curve. So here again, we have another positive factor helping us have a little extra probability getting stacked in our favor. So yes, we are at the best location. Now the best part is, at best location, trend becomes irrelevant. So you can even skip doing your trend analysis, because by default, irrespective whether it is uptrend, downtrend or sideways, it will be a score of 1. Move from the zone, we need at least 4 is to 1 move. Let's verify. Do we have a 4 is to 1 move? The answer is yes. We already have a 4 is to 1 move. Gets a score of 2. It is not a case of level on top of level, but definitely a coinciding level. Now, trap can also be skipped, because we know, irrespective whether it works like a trap or it doesn't, it will remain as a type 1 trade for us. But the fact is, it can also work like a trap, because if I take a horizontal line wherever the proximal is and start pushing it up, you can see almost this area is textbook example of support and resistance. You can see work like support, 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 then working like resistance, working like support, working like support, almost work like resistance, again working like resistance. Here again it has started working like support. Here also it gave a small bounce. So we do have, I'll say, almost a textbook example of support resistance. Now what is going to happen? People who believe in support resistance, at support they will be buying, and their stop losses will be below this area, and those stop losses will be sell orders. And if we get a breakout, then people who believe in breakout will also start selling. So by the time we enter this demand area, we know we'll have a lot of people selling because of their stop losses, because of the breakout trading. And these people are making two novice mistake. One, selling after a decline in price, which means selling at a cheaper price. And mistake number two, selling in an area where the chart has proven to us that back in history, demand was more than supply, which could be the only reason for prices to move up. So yes, that possibility is there that it might work like an area of trap, for which I've already given it a score of 1. So no, I have to give. So it is a high quality, high probability trade setup, and high quality, high probability can be traded as a type 1 trade. So after applying the boosters, we got to know this is a type 1 trade for us. Now the next step is, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we also need to be ready for the worst case scenario, so that in case the trade does not go in my favor, I do not lose more than what I'm willing to lose. So that is why position size calculation, very very important aspect of your risk management. Now whenever the prices are back, we'll have to re qualify it, and the reason for that is because markets are not static, markets are dynamic, conditions are changing almost every other second. So before entering into a trade, before placing our order, we always have to ensure that it still qualifies based on our trade plan. If the answer is yes, it is qualified, we'll place our order based on the entry type. In this case, it's a type 1 trade. And once your order has been executed, the last step is your trade management, where step 1 is 1 we make it as a break even trade. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule based. And that is what we do every practical session. We look into how to apply the complete process. Now I can see quite a few questions in the chat box, but before we get into those queries, I would like to add, if these sessions are helping you, I'll highly appreciate if you can hit the thumbs up button. And if you are into some trading groups, or if you have any friends or family members who are into trading, you can share the link to my videos, to my course content. It might be helpful for them. So let's see what we have in the chat box. Is there a way that you can utilize scanner to identify tickers that you might utilize demand supply scanner alerts to evaluate potential setup and trade opportunities, creating a watch list? So let me try to understand what you're saying here again. Is there a way that you can utilize scanners to identify tickers that you might utilize the demand supply scanner alerts to evaluate potential setups and trade opportunities, creating so what you're saying is, can we create a watch list by using these scanners? And that is what we are basically doing. So if I go here, you can see the scanner is telling me that out of those 40 symbols, I don't need to analyze all those 40. If I am only planning long trade, I can analyze this one. If I'm okay with both longs and shorts, then I can also scan this. So I already have a watch list now for these three symbols, which I can analyze. Out of this, whatever matches with my trade plan, then it can go to my further watch list. Okay, these are my tradable opportunities. I hope I got your question correct, but in case I didn't answer it correct, maybe you can rephrase it so that I can understand it better and help you with that query. Okay, a while back I asked if it is possible to get a copy of the worksheet you showed in how to trade video. And a copy would be made available for use. Okay, I remember. Sorry, I guess it. I'm not. I guess I'm pretty sure it skipped my mind. I think you're talking about the Excel sheet which generates those random results, right, with the reward to risk ratios, right? So let me just note it down, on my notepad. The Excel sheet for reward to risk ratio, right? So I've noted it down, and probably the next session I will share the link to this sheet, right? So I've already noted it down. Okay, what is the win rate of this strategy? So Ashish, now this is something I have talked about many times. In fact, the Excel sheet which we are talking about is basically a very good example for you to understand that as well. So the link to the video, which is how to start trading, is available in the description. Go through that video. In fact, I also have a video on this topic which is called as reward to risk ratio. Also, watch that video. Now, coming back to your question, the win rate, we'll talk about it. But whenever somebody asks me what is the win rate of a strategy, always tell them that's the incorrect question. Why? The reason is the win rate never decides whether the strategy is a profitable strategy or not. Now, a very simple example can be I might be risking 10k to make only 1k, right? That is something a lot of people they do, right? With small profits they exit, but when they have losses they keep holding on to it, and those losses become very big losses. Now, if I'm doing something like this, even if I'm right 90% of the time, so my hit rate is now 90%, but will I be profitable? The answer is no, because whenever I'm making money, I'm probably making a very small amount, but whenever I'm losing a very big amount. So even if my hit rate is 90%, I cannot be a profitable trader. But if it was the other way around, if whenever I was winning 10k, and whenever I was losing 1k, which is a reward to risk ratio of 10 is to 1. Now I can be wrong 90% of the times, which means now my hit rate is only 10%, but I can still be a profitable trader, right? So that is what you need to understand, that hit rate is never the key component which decides whether the strategy is profitable or not. It's always the reward to risk ratio. If you have a good reward to risk ratios, you can be wrong more number of times, but and you can still be a profitable trader. Now, coming back to what will be the win rate, this will depend upon a lot of factors. Example, what kind of trades you're taking, whether you're doing more of HITs, whether you're doing more of MITs, how aggressively, how conservatively you're planning a trade. But I'll say on average, you might be somewhere between 60 to 70%, right? If you're a little on the conservative side, right? Again, I'll add, if you're a little on the conservative side, you might be having a hit rate which is hovering around maybe somewhere around 60 to 70%. But do not assume that just because we are doing demand and supply, we might have a 90% hit rate or a 95% hit rate. Yes, you might have a week, you might have a month where things are going really beautiful for you. But once you have a big enough sample size, maybe somewhere between 60 and 70. Any pointers on how to best optimize the use of alerts to pinpoint potential trade setups for tickers that you are following, to make sure you don't miss potential trade opportunities? See, the only thing is, don't set your alerts very close to the zone. So let's say if I'm saying, okay, this is where my zone is, and as soon as I'm, let's say, half a percent to it, I want to get notified, because by the time you go to your screen, you do your analysis, maybe you would have already missed the opportunity. So that is the only thing which you can keep in mind, that I should have a little bit of room, so that by the time I am done with my analysis, I can place my orders, and by the time prices have not yet hit the zone. So that is the only thing you can look into, that not very close to it, but you still have a little bit of time, right? Other than that, I don't think anything else is required when it comes to setting the alerts. Okay, I would like to ask why future trades, that is S&P 500 and Nasdaq 100, always have confirmation when it comes to entry. It's like we have to, what we have, we do here on type 2 type 3, what's the difference? So again, see, just because you are planning your trades on the indices like S&P 500 or Nasdaq, does not mean there will always be type 2 type 3 trades. In fact, what you will eventually realize is that the more you try to get into type 2 type 3 trades, the more number of trades you will be missing. So maybe when you're planning trades, as if now you're not being very selective, that could be the reason why most of your trades might be ending up as type 2 type 3 trades. But once you start getting more and more conservative with your approach, you will see a lot of trades will be type 1 trades. And even if, let's say, majority of your trades are falling into type 2 type 3 categories, like I said, then the next challenge will be you'll be missing a lot of trades. So it's all about quality and probability factor. If you are taking care of it, majority trades can convert into a type 1 trade. Okay, I understand you should concentrate on quality zones when evaluating potential trades. I suppose you can't dismiss other zones that aren't quality. Should you evaluate those for trades? See, I completely understand with you. Now, even if you look at the example which we were looking at as of now, can you see, if I when I change the settings that I want all zones, we actually were inside of a demand area, and that is where we started moving up on Friday. Right now, yes, prices can react from areas which might not be quality areas, and I might not get my opportunity, right? But at the end of the day, you have to decide as a trader what uh, your approach is, right? Whether you want to look at every zone and plan your trades, or whether you just want to focus on the quality zones. Now, what I can say, the differentiation factor here can be how many symbols you are trading, right? So example, if you're only focused on, let's say, 4 5 symbols, now you know that on these 4 5 symbols, if I'm always waiting for quality areas, I might get very few trades. So that is where, yes, it definitely makes sense that I can even start looking at areas which might not be quality areas, because my array of symbols is already a very small array of symbols. But now if you are looking at a big enough, let's say, array of symbols. Now if you take my example, in my scanner I have covered all the symbols that are getting traded on the NSE exchange. So I have over 200, sorry, 2000 symbols to look into. So when I know that I have a very big array of symbols available to me, why do I have to go for zones which are not quality zones, right? That is where I start focusing more on quality zones, because I can do that, right? So that is how you can decide whether you want to go for only quality areas, or whether you're also okay with non-quality areas, just because the number of symbols available to you might be a very small list, right? So that could be the deciding factor there. Assuming that the non-quality zone meets, passes the score. Yes, so again, if it is a non-quality zone, but if it is still qualifying based on your trade plan, why not, right? It's absolutely perfect, nothing wrong with that. Okay, so I have the term, staging the trade. Should you use it as a set and forget it, so you don't get emotionally involved with the trade once you have set it up? Any see again, coming back to trading, the more I shouldn't say more. The lesser we are involved, the better it is for us, and that is what you will see eventually. That the less you are in front of the screen, the better your results will be. And in fact, when it comes to demand supply methodology, you probably would have heard me saying it many times, that we also call it as set and forget, because you can plan your trades in advance. You know where your entry is, you know where your stop loss is. Now, if you take this example, this can be a purely set and forget trade. Why? Because this is also at the best location. So even if my lower time frame does not show me good reward to risk ratio, I know from the intermediate time frame I might get a better reward to risk ratio. So yes, trades can be done as set and forget, and that is what I do for most of my trades. You can see I have my alert set, so as soon as prices are closer to the zone, that is the only time when I get my notification, I go and re-verify. Once I've re-verified it is qualified for me, I simply place my order. And after that, almost at the end of every day, if I have to use some trailing stop losses, or if I have to make some modifications, I do that. But otherwise, during the live market, most of the times I'm not even in front of the screen unless and until I hear my alerts, and I have to go back and check what that particular alert is all about. Great. So what to do on supply, that the leg, it sweeps the distal line of a zone moving to refining time frame. Do we take mainly rally based strike? So let me try to understand this query. What do we do on supply that the leg in, okay, sweeps the distal line of the zone, okay, moving to the refining time frame? Why do we take mainly rally based rally? So I'm not able to get this query, so if you can rephrase it, maybe it will be easier for me to understand it. But as of now, I'm not able to understand that query, so apologize for that, for X5. So, Sujit, if market is in downtrend, we should look uh, into Nifty or follow our rules. So, see, if the market is in downtrend, if you want to plan some short trades, you can even do that. But again, if the market is in downtrends, it might be bringing prices on some of the symbols, which will be now coming to demand areas. We can also plan our long trades as well. So, at the end of the day, you have to decide what you're more inclined towards. Now, my challenge is that I only trade in the cash market, and because I only trade in the cash market, I can only plan long trades. Because short trades can only be done intraday in cash, and for futures, then there are challenges, which is you'll have to roll over and all those things. So I prefer to only trade in cash, which is where risk management also becomes easy. Again, in futures, you have fixed lot size, which is again a challenge. So yes, based on your personality style, based on your risk appetite. In downtrends, if you want to even plan short trades, you can do that, provided things are located at good locations, qualifying based on your trade plan. So all those things definitely will come into play. But yes, you can plan both sides of it, because like I already said, downtrend are also making the prices cheaper. which can help in participate some of these stocks. Okay, I've done your course 2 years back, and moving here and there. I again visited your channel and found only rule-based strategy works in market. What see again that this is how it is. Once we learn a methodology, it's not just with you. I've seen a lot of people, they are always looking for that holy grail because they want to have a strategy where every trade is going to be a profitable trade. And that is what we always searching for. But eventually we realize nothing as such exists. So that is where we go back to something which is mechanical, because if it is mechanical, easier for us to apply. And plus, on top of that, if you have beautiful reward to risk ratios, it becomes much more easier to be on the positive side versus strategies where your reward to risk ratios might not be really good. So yes, the easiest way is, Ashish, the process that I talked about, how to start trading, irrespective whether you're doing my methodology or somebody else's methodology. Have that patience, go through that process using that methodology, probably maybe once, maybe twice, have a big enough sample size to understand what is working for you. Once you have the confidence in that methodology, then just keep working on it, right? Try to improve on it, and that is how you'll start becoming a better trader. The response you provided on alerts is exactly what I was thinking, setting to 0.5% or 1% within a zone to ensure you can act on time to take advantage of that. Absolutely, right? So, not within the zone, before it enters the zone, right? So, that is how it has to be. Okay, keeping a reasonable number of tickers you are following is key. Concentrate on quality. Absolutely. So I agree with that as well. Again, if you have a good enough sample size, quality would be much better versus going on quantity and looking at zones which might not be quality zones. All right, perfect. So that brings us to the end of today's session. Thank you so much for joining in. I will be seeing you now the next weekend. Until then, trade safe. Enjoy your Sunday. Take care. Bye bye.